much, Dylan. Investors reacting positively to Vice Chairman Donald Coe's comments this morning, in which he gave hints of another rate cut coming. On call today is Joe Livornia, Managing Director and Chief U.S. Economist at Deutsche Bank. He's here for the whole hour. Also with us, CNBC's Steve
Listen to this, no light.
Santelli. Joe, you're our guest of honor, so let me start with you. You know, the thing that stuck out to me the most was the section on the moral hazard of not holding the economy hostage to the lessons of a few. What struck you?
I think, Melissa, that's exactly right. But what I found most interesting was in the Q&A session, he basically said, look, there is tail risk right now in the economy, and the Fed will want to do a little bit more to address that risk, meaning if the Fed's going to err one side or another, it's going to be toward lower rates. And Cohn did not really play up the inflation risks, and he did not sound anything like President Plosser did from Philadelphia yesterday, perhaps even a bit like Chicago Fed President Evans, and certainly not like Governor Krosner a few weeks ago, who was very clear in his desire not to cut rates.
Steve, what about you? Was anything in here surprising? I mean, it seemed even more positive if positive is looking for a rate cut than we thought.
I thought the whole thing was kind of a little bit surprising in the sense, actually it was a little bit gratifying of seeing the Fed back on track and seeing the same things that I've been seeing and that the markets have been seeing, which is the credit markets were really hurting, not doing well, and yet the Fed speakers who we listened to before that hadn't really acknowledged it. It was as if they were turning a deaf ear to it, using this sort of stock phrase, which is that, you know, we expect weaker data, but we still think monetary policy is appropriate. That's the first phrase I looked for in Cohn's statement this morning. Didn't see it. And I think that was very significant. He's also not saying the risks are balanced. And I think the most important thing of what he said is that things have changed. And he asked specifically what's changed. He said, well, credit markets have deteriorated. That increases the risks, sort of picking up on what Joe said, of a worse outcome for the economy. And saying moral hazard, you know what, guys, get over it. We got a job to do on the economy, and if there's moral hazard here, we'll take care of that later.
And to add to what Steve is saying, I think what Cohen is a seasoned speaker and been there for a long time and very competent. He knows that the markets have been way ahead of the Fed for a while, and this Fed rhetoric, this consistent rhetoric that Steve mentioned, really did the markets no service. The markets rallied in the face of that, and I think Cohen is probably of the view that the Fed needs to follow the markets. They won't say it explicitly, but they're not going to run the risk of this rally we had today dissipating, going back to the lows.
And so we were down 7.7% at one point on the stocks since the Fed said the risks are balanced. What did the market say? Risks ain't balanced.
Well, wait, let's bring in the great Santelli out there. Weigh in for us, Rick.
You know, I can't believe what I'm hearing, honestly. And viewers, you want to really know what's going on? I'll make this easy for you, really. Let's show a 6-month chart of the Dow Jones Industrial Average. Notice that the only 2 times in recent memory that you've had 2 things going on at the same time, credit issues and a stock market closing under 13,000. And lo and behold, in mid-August when it happened, they lower the discount rate. Now, even though we've had 11 days of LIBOR telling the Fed what you're doing isn't fixing the credit crunch, and they've known that with the Fed speak a couple of days ago, all of a sudden, Mr. Cohen, with the equities about a 10% correction off their highs, come in to save the day. Look at the way the stocks reacted. Listen, guys, you can talk all you want. The Fed can lower rates to 0. It's not going to change the credit market. It's going to make investment bankers. Okay, how is it going to make one of those CEOs change in price?
Why is the stock market up today? Part of it's short covering, but it's also because the market believes the Fed is going to provide liquidity to try to mitigate downside risks to growth. So things would be even worse in the absence of the move, and if they didn't
You're
cut.
right. You're absolutely right. They're going to help save the growth side, but the analogy should be we're on a camel. Its humps are filled with water. We're in an economic desert. When the humps run low, we have 4.5 bottles of water. That's the target rate. Maybe they should save the water till a little bit later in the game.
Why would they save the water if the camel is dying because you're restricting? Lending standards are tight. You have a mortgage credit crunch.
But they're not easy lending standards.
Of course they're not, because the market is worried about liquidity. People are hoarding good assets.
No, the market's worried about crummy financial collateral. The market's worried about crappy collateral.
No,
that's what the
every
market's
central banker has done before in the face of such a crisis, which is they lower the cost of funds for the banks, which makes it easier for them to take the kind of risk when they get around to doing it. Rick, if you want to win,
it makes it so they can make some money to subsidize the credit crunch that they're using as an excuse to ease.
Rick, your very argument about LIBOR going up is exactly the reason that Cohn said the Fed needs to ease. LIBOR is a real rate.
It's exactly the reason it isn't working.
Rick, LIBOR is a real rate that banks pay and businesses pay, and a lot of things are pegged off it. As it goes up, credit standards are tighter. It tells the Fed it is too tight relative to what the market is saying.
But no, see, it is working because I would argue if the Fed wasn't cutting, LIBOR would be significantly higher. LIBOR, a lot of bank-sponsored paper was trading about 65 over LIBOR back in August. We've now blown out to 30, 35 basis points. If the Fed did not cut, I would argue LIBOR will blow out even more, especially heading into year-end.
Okay, Joe. I can't argue that, Joe, because we can't argue what would have been. But let's paint a picture here. If around March, April, May of 2008, the economy numbers start to really sputter, and the overnight rates at 3.5 to 3.25, do you think the Fed's going to have as much efficacy if they would have kept their powder dry?
Absolutely.
Oh, they will not.
Rick, you take the Advil before the hangover comes, not afterward. It's too late.
Yeah, but you have an arm that's gotten gangrene and the aspirin isn't working.
That's why Advil, Rick, ibuprofen.
All right, gentlemen.
Rick, your headache would be much worse, Rick, if you didn't take this Advil right now. Rick,
that's
go
true.
take 2 aspirin, call me in the morning, buddy.
All right, gentlemen, thanks so much for joining
for a living.
Steve Leisman, Rick Santelli, Joe, stick around. We'll be talking to you throughout the show. And be sure to tune in to Street Signs today at 2 p.m. Eastern when the Fed releases its beige book on economic conditions.